Hello, my name's Charles Dynastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is probably quite specific around people who own offshore properties but who are liable to UK inheritance tax. How do you solve that particular problem and get those foreign properties out of your estate for UK inheritance tax? Okay, so if a person is born in the UK, in other words, they have a UK domicile of origin, or they are deemed a UK domicile, they've been living here for 15 out of the last 20 years, their worldwide assets are liable for UK inheritance tax. Now, sometimes when there are offshore assets held, there will be double taxation agreements where part of the inheritance tax is paid in the country where the assets are held. Now, this offshore tax will then reduce the amount of tax that's payable to the UK. Generally speaking, inheritance taxes in the UK is higher than anywhere else in the world. So generally speaking, there will be additional tax to pay at 40% to the UK government. So what can you do about it? So firstly, you could put property into a trust during your lifetime, but there are a few issues that you need to be aware of in that particular case. If there's rental income, for instance, from a property, then the income tax issues in the country where the property is held can be quite complicated if the property is then owned by a trust. There are also many countries like France, Spain, Italy, which simply don't recognise trust, and therefore that particular planning would not work at all. Now, it is possible to put all foreign property into a UK company, or better still, a UK family investment company. Now, all countries in the world recognise companies. There's no issues around that. But you'll still need to be aware of the taxation issues arising in the country where the property is held and how this may impact your UK company. Obviously, we are able to help you on the UK company, but we can't be experts on tax in every single country in the world. Now, the shares of your family investment company in the UK can be given away directly to your children or to an employee benefit trust if there are large capital gains tax issues on the gifts of any of those shares. So the gifts of the shares will reduce the value of your estate and the inheritance tax payable, and because the company owns the property, by definition, that's going to reduce the overall tax by disallowing basically the value of the property in the company because the shares of the company have been given away. Now, another methodology is that you could, if you don't want to go down the route of family investment companies, and yeah, it's work and it's a bit of complexity, you could just take a mortgage out against your foreign property. Then, let's say you own a property worth 500,000 and you take a £300,000 mortgage out against that property and you can afford to pay the rent. You can then take the mortgage money that you've extracted and you can gift that money into a trust, for example, in the UK, or you could gift it to a company or a family investment company, or you could give the money, worst case, directly to your children. We rarely recommend that because obviously if your children get divorced, that money's going to walk. So you need to think about how you're giving monies away, but inevitably that still works, taking a mortgage and creating a debt against the property. Obviously, last case scenario, you could sell the property and then use the money to gift into trust or companies or give it directly to your children. Okay, that's it. Hopefully you found it useful. If you did, please give us a like. But thanks for listening, and bye for now. Bye.